Good evening, everyone. Welcome to the channel. Today I am going to talk about Dave and Buster's Entertainment, Inc. quarterly report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. Dave and Buster's Entertainment, Inc. offers a variety of businesses and services through its entertainment and dining venues. The company provides a menu of entrees and appetizers, alcoholic and non-alcoholic beverages, entertainment attractions such as plus bowling, plus laser tag, plus arcade games, plus virtual reality experiences, live sports and televised events, viewing areas. The company operates under two brands, Dave and Buster's and Main Event. Dave and Buster's Entertainment, Inc. Stock price decline. A summary of key factors in the past year. Dave and Buster's Entertainment, Inc. Stock price has plummeted by over 37% due to a combination of disappointing financial results, declining comparable store sales, and broader macroeconomic pressures. The company's weak second quarter fiscal 2025 results, reported in September 2025, were a significant contributor to the decline. Revenue fell short of expectations, and comparable store sales decreased by 3%. Net income plummeted to $11.4 million from $40.3 million in the same quarter of fiscal 2024. Additionally, disappointing first quarter fiscal 2025 results, reported in June 2025, showed a decrease in revenue and net income. Comparable store sales significantly decreased by 8.3% compared to the prior year. Ongoing macroeconomic headwinds and declining consumer discretionary spending have also impacted the company's performance. The challenging consumer environment has led to decreased spending on entertainment and dining activities, affecting visit frequency and spending patterns at Dave and Buster's. Furthermore, increased costs and expenses, such as labor and marketing costs, have negatively impacted the bottom line. Analysts' bearish sentiment and price target reductions have also contributed to the decline in stock price. Overall, these factors have cumulatively led to a significant drop in Dave and Buster's Entertainment, Inc. stock price over the past year. The primary drivers of revenue growth or decline can be identified through a review of key financial metrics. Revenue growth is primarily driven by an increase in food and beverage revenues, new store openings, and sale-leaseback transactions. Conversely, revenue decline is attributed to entertainment revenue deferrals, decrease in net income, and increased capital expenditures related to gaming updates. The mixed or stable category includes total revenues that remain relatively stable with a 0.3% growth rate. Store operating income before depreciation and amortization also shows stability, while adjusted EBITDA experiences a decline. These metrics suggest that revenue growth is offset by various factors contributing to revenue decline, resulting in a mixed financial performance. Net income and profit margins decline. A summary: the financial performance of the company has taken a significant hit, with net income decreasing by $28.9 million from Q2 2024 to Q2 2025, and by $48.6 million from Q1 2024 to Q1 2025. This decline is attributed to various factors, including a decrease in comparable store sales of 3.5%, which led to a reduction in adjusted EBITDA by $21.8 million. Profit margins have also suffered, with operating income margin plummeting from 15.2% in Q2 2024 to -9.6% in Q2 2025. The decline in profit margins is due to an increase in depreciation and amortization expense, non-cash interest expense, and a decrease in deferred taxes. The company's adjusted EBITDA margin has also decreased from 27.2% in August 2024 to 23.3% in August 2025, while store operating income before depreciation and amortization margin has dropped from 31.1% to 27.9%. The timing changes in working capital have further contributed to the decrease in net income. Overall, the company's financial performance has been impacted by a combination of factors, leading to a decline in both net income and profit margins. The company is experiencing financial difficulties, as indicated by its negative operating cash flow. This trend has continued from the previous year, with a significant decline in operating cash flow of $80.8 million. The decrease suggests that the company is struggling to generate sufficient revenue to cover its operational expenses, resulting in a net outflow of cash. The company's debt level and interest expenses have seen significant changes over the past year. The company's long-term debt has increased by $70.4 million from $1.479 billion to $1.549 billion, while its total debt has risen to $1.589 billion as of August 5, 2025. The total revolving credit facility has also increased by $400 million to $650 million. Concurrently, the company's interest expenses have surged significantly. Net interest expenses for the 3 months ended August 5, 2025, were $38.7 million, a 14.2% increase from $33.9 million in the same period of 2024. For the 6 months ended August 5, 2025, net interest expenses reached $75.5 million, a 12.8% rise from $67 million in 2024. These changes indicate that the company is shouldering higher debt and interest costs, which may have implications for its financial health and future performance. Management is optimistic about the company's outlook, citing improvements in labor and operational efficiencies through a 52-week or 53-week fiscal year. They plan to expand their business by opening new stores and investing in operating improvements. The company will also continue to monitor the impact of the One Big Beautiful Bill Act on its operations. With sufficient cash reserves and expected cash flows, management is confident that they can finance their growth strategy for at least the next 12 months. The company's financial summary reveals that it has taken steps to return value to its shareholders through 2 key initiatives. Firstly, the company has not paid dividends in recent periods, indicating a focus on reinvesting profits within the business rather than distributing them to investors. Secondly, the company has engaged in share buybacks, repurchasing 1.04 million shares at an average price of $23.03 per share. This strategic move demonstrates the company's commitment to enhancing shareholder value through targeted capital allocation decisions. There are no explicit concerns about inventory buildup or supply chain disruption in the financial summary. However, a mention of transforming supply chain operational efficiency suggests that potential issues may be being addressed. Decreases in costs due to vendor savings and supply chain optimization do not necessarily indicate any underlying problems with inventory buildup or supply chain disruption. That concludes the financial summary for Dave and Buster's Entertainment, Inc. Feel free to comment below, and I will be happy to answer them when possible.